More countries are expected to get these tariff letters, threats from US President Donald Trump. Remember, yesterday he seemed to indicate that he'll impose a 50% tariff on copper and a levy of up to 200% on pharmaceutical imports. Let's get more from Nancy Daoud, private wealth advisor at Ameriprise Financial and CEO at Opus Advice First. Thank you very much for joining us, Nancy.
Thank you for having me.
Give us your overall impression. We've heard a few commentators saying that these tariff threats aren't worrying equity investors as much as they used to.
Yeah, I think that may very well be true. We've seen a bit of a pattern here where, an announcement is made, but then the due date becomes moved up. It gets moved out a little bit. And I think this is an honest attempt to get some negotiations going as opposed to just imposing tariffs across the board and being done with it and creating havoc in markets. But in general, now stocks are mostly overbought through the first half of the year. The big beautiful bill has passed. The debt ceiling has been raised, and the tariffs have been moved up. So there's still a great deal of optimism, and actually that might probably be the biggest risk, the risk of disappointment.
So when you say stocks are overbought, does that mean they'll have trouble rising further for the rest of the year, the S&P 500, for example?
Well, I think there's still some room in the S&P 500, but stock selection will be very, very key at this point. The sectors that we are very much interested in are obviously technology and utilities. The demand for growth tied to the multi-year build out of AI is very strong. So there's certainly some upside potential there. Financials will likely do well. The healthcare sector, that's the place I would probably not want to go. The headwinds are clearly with pharma, biotech, and managed care. There's a big tug of war with the pricing. But even in that sector, med tech, a few handfuls of selected med tech companies could probably do well. So it's a tricky road for the second half of the year.
We've learned over the past few months, well, I was surprised to learn that how global the trade in pharmaceuticals is. The US brings in a lot of drug materials and drugs from Europe and from Asia. So a massive tariff on pharmaceutical imports would be very disruptive.
I would think so. And it's already been very disruptive in that sector. But like we have seen before, it's not over until it's over. I mean, there's a massive announcement now. We'll see where that leads down the road. So I think it's prudent to be cautious. Investors should be very, very well allocated. And cash that is needed in the next 2 to 3 years should be on the table already, seeing as the market's hitting all-time highs. And we should be a bit more defensive.
What do you mean there? Sorry, cash that you're going to need in the next 2 or 3 years, you wouldn't be taking risks with it, in other words?
Exactly. If you're going to spend, if you know you're spending a certain amount of money in the next 2 to 3 years, that should be off the table already, or you should do that immediately. From one day to the next, nobody knows what's going to happen. Although the economy is very strong and things are becoming a bit or slightly more predictable, there's still a significant amount of geopolitical risk. As you could see, the wars are still raging overseas. And those are some of the wild cards that could cause a bit of a problem in the markets in-house here domestically.
Tech, AI, you are broadly bullish on tech. Would you have a preference? Would you go for our friends, the chip makers, or companies such as Salesforce? Sorry, go ahead.
No, I'm sorry. Chip makers, semiconductors are certainly the key sectors there. But in general, anything related to, there's a significant amount of competition in that space. And of course, turns out AI needs a great deal of power, so utilities are going to be very, very important part of all of this.
Just finally, we're tight for time, but it sounds like you don't anticipate that much inflation in the sense that you think long-term bonds look decent right now, and also utilities, and they would be likely to suffer if interest rates went up because of inflation.
Exactly. And so far, the first half of the year, both sectors, IT and utilities, have done extremely well. But we believe that there's probably a little bit more upside potential here in the rest of the year and certainly longer term.
Just finally, if I could ask, we're not going to stray into politics, because I know you should keep politics out of your out of portfolio management. But have you ever seen such an unpredictable political environment in your career?
There's variations of, I have to say we've been here before. And one of the benefits of being in this financial industry for so long, I've pretty much seen it all. The underlying variables may be different, but unfortunately, human behavior doesn't change. So history just keeps repeating itself as to how investors behave. And that's in a way making it a bit more predictable for me as an advisor on how to advise clients.